Keynote Panel, Top Trends That Will Shape Private Equity in the Coming Years. I would like to welcome my panelists, Rich Lawson, Mark Satir, TJ Maloney. Sorry about that, TJ. And so I'll let Rich start off with introductions, and then we'll go straight into the trends.
Hello, everyone. Rich Lawson, HGGC. We are operators that sit out in, I guess, sunny California, as it's been called in recent times. We're a partnership investing firm. We've done $25 billion of transactions over the past decade, with roughly $6 billion of equity across 180 discrete deals. We're multi-sector. We invest in partnerships. We think there's a gap between buyout-focused control investors and earlier stage growth capital and venture firms. And just delighted to be here and join this virtual discussion.
TJ?
Sure. Happy to get it started. Good afternoon, everyone. I'm TJ Maloney. I'm Chairman and CEO of Lincolnshire Management. Our firm is roughly $2 billion under management through 5 funds. We started in 1986. So this is our 35th year. We've purchased over 100 companies, include such iconic names as Prince tennis rackets. For those of you who are divers, we owned a company at one point called Patty. Wabash was another business we owned, which was truck trailers. You'll see that on most highways. We'd owned at one point a company called Riddell for football helmets. Holly, which was a designer and marketer of branded performance auto parts, sometimes called Holly Carbs. Another business, Transcraft, was flatbed trailers. And for those of you with swimming pools, we owned a business called Polaris, which was a manufactured pool cleaning devices. So we've had a lot of iconic brand names over the years. Today, I'd like to address my remarks to 2 areas. First, managing your portfolio companies through this pandemic. And secondly, purchasing new companies during the pandemic. Firstly, when the pandemic hit last March, and I'll never forget that day.
Yes. TJ, we're going to let Mark introduce himself, and then we were going to start into the questions. Is that okay?
Oh, I'm sorry. I thought we were going to do this start and go for 8 minutes. Thank you.
No.
Okay.
All right, Mark.
Hey, thanks. Mark Satir, I'm the president of Equity Group Investments, and we're a private investment firm that does direct investing, very much like a PE firm, but we have committed capital from Sam Zell and his family, and that's where our capital comes. So I get the nice benefit of that. I don't have to raise capital. We have a lot of flexibility in our investment mandate. We cut across industries and geographies. We don't just do private deals. We invest a lot in public entities, and don't have a lot of pressure to deploy money each year. If we think there's opportunities, we do, and if we don't, we don't. The big thing, though, that we spend a lot of time on is the capital. We have an ability to hold companies for a very long period of time. Again, I have real reinvestment risk, and so duration is a thing we pay a lot of attention to. Sam, we just sold one of his companies that he's owned for 34 years. We own a lot of businesses, at least a decade, if not more. And so, not that that's good or bad, but it makes you think the lens you stare at in terms of how you make investments is a little different when you're thinking 10, 15 years out. So that's who we are.
Great. And my name is Andrew Wilson. I'm the Vice President of Private Equity and Mergers and Acquisitions here at Global Upside. We've been around for 20 plus years. We specialize in international human resources, due diligence, and employee transitions on carve-outs and spin-offs, setting up legal entities and standing up human resources, payroll and benefits, and then hiring employees also on our own PEO employer record services, where we have 60 plus international legal entities in countries around the world. So very much happy to be here today. So I'd like to start with Rich, if we could, and talk in terms of, obviously, shaping the coming years is definitely the pandemic's very much in our minds at the moment. So in terms of the pandemic, Rich, how have you reacted to the changing landscape in different industry segments and geographical areas?
Well, I can certainly speak for the state of California, and the sky is not orange today, as I was mentioning before, thank God. But it was very interesting because California was one, and we're based here, one office. only in America, right, or only in this global economy, you can have a private equity firm that employs 60-some thousand people in the portfolio spread geographically all over the world. But when we learned of the pandemic, March 11th, the state of California was rather forward thinking and actually shutting down. March 13th, we closed our office. No one has returned to our offices in California, but it created two interesting situations for us as we thought about focusing on our portfolio companies. We attacked all of our portfolio companies with this notion of employee health and safety. How are we going to deal with changing investment impact and strategic impact, capital structure? How are we going to work with our companies, as well as demand, revenue risk, and supply side operations risk? Having been former operators, we approached every one of those companies, and what we found was that there were certain end markets that were profoundly impacted. We have a number of companies that serve the auto industry. Never in a million years did we think that Detroit was going to stop manufacturing vehicles, nor would dealerships stop buying products that would service those very end customers. So from a standpoint of end markets like retail, end markets like automotive, even event, we have a company that does event planning software, if you can believe it. Imagine no conferences, right? When a third of its revenue is derived from services associated with that. So we had to fundamentally rethink as we supported these businesses, how we were going to navigate this new normal. And I would tell you the other interesting piece is it wasn't just by end market, it was by geography. So again, in the state of California, having a very large company that's a manufacturer where 40% of their product is being manufactured in the state of California, a very large impact for us. So we had to really rethink how, in working with those businesses across those 6 different metrics, particularly around employee health and safety, we were going to navigate this and be successful. And that's the lens we've taken, Andrew. Great.
And has the current environment created opportunities for you? Do you see both the growth organically in your portfolio companies, as well as opportunities to acquire and augment your current portfolio companies through acquisition?
Well, it's actually somewhat counterintuitive, to be honest with you. We have done over 36 acquisitions during the pandemic, and I never would have thought that that was a possibility. It's because what we've learned is there are a number of businesses that would rather be part of a larger platform. They recognize the challenges. They want to grow. So much of our structure has always been this notion of partnership investing. So we never buy 100% of a company. We typically tend to partner 70-30, 60-40, 50-50 with the seller, whether it's a sponsor, founder, or management team. So what we found, Andrew, during the pandemic, we continue to make platform investments, but the platform investments we've made in our existing portfolio has seen such an influx of add-on opportunities that was the thing that shocked us the most. So for this audience, all of us being former operators before we became private equity professionals were in the ecosystem, it created a tremendous opportunity to augment our operations team, augment the kind of portfolio company targets that we were looking for. And to be honest with you, we don't see that trend slowing, because today, whether it's a large standalone platform or an add-on, we're getting more calls now because no one wants to sell 100% of their business in this environment based on what we're seeing.
Excellent. Great. TJ, how are you managing your current portfolio companies through the pandemic?
It's really been a mixed bag. Generally, it's been pretty good. I started to say earlier, I remember it was March 11th, and I was sort of pushing to travel a little bit much. I was in Memphis for a new product introduction for a company we own called True Sports, which makes golf shafts and hockey equipment. And as we're going through these new product introductions, it comes across the television screen, PGA Tour is canceled, the National Hockey League season was canceled. And I remember thinking, wow, this is not going to be good for business. However, we really were able to adjust very well. And we have a major steel mill in Mississippi that makes the golf shafts, and we normally furlough that in the summer to retool and get it ready for the rest of the year. And we just sort of pulled that forward a little bit, and watched our costs, and then golf really started to do quite well. Actually, it's an outdoor sport, socially distanced, that type of thing. So The company had I think a rough April, but it's come back strongly since then. And we jumped on the thing early with an action list and crisis management teams. Obviously, as Rich mentioned, focused on the health of the employees of all the companies and our own employees, of course. But then, of course, you're focusing on availability and making sure that the companies have enough cash to operate. We were immediately in touch with all the banks to tell them that we were going to draw down on the revolvers, which we did. And we had teams in place to look at all the different assistance we could get. There were we have some companies overseas, so they actually qualified for support from the various governments in Europe. And however, as most of you know, the companies here did not get any PPP money unless they had some prior existing situation, which we had with one portfolio company. But we've been managing very, very well through it, and I'm very pleased. I think we have, we had some companies that are having their best year ever. So it's really been a mixed bag out there.
And what are your considerations in terms of purchasing new companies? What are you looking at in terms of both augmenting your existing portfolio companies or new areas that you're looking at?
Well, a bunch of things. We bought, two companies. One company that can do sort of refresh and rebuilds for major chains across the United States. So, if you're a Walmart and you're putting in a drive-up window to pick up groceries you ordered online, this company has the capability of putting those windows in at 2,000 locations in 90 days. And what we've done with the company is we've migrated into a lot of cleaning services, and we've gotten some EPA approved equipment that kills the virus and stays on the surface that has been sprayed on for many, many days. So we're providing those services to a lot of the national chains out there, which has been kind of exciting. And we recently bought a business which is the largest battery charging, battery conversion business in the United States, and it seems to be doing very, very well. People are all, as Rich knows, in the automotive business, it seems like there's more and more used cars on the road than there are new cars, and they tend to need chargers more. So that's all been very good. And we have products for the electronic vehicle market, which we're also ramping up. So that's what we've been doing. Now we drive to these companies. I mean, if I get in a car and drive 800 miles, 1,000 miles, that's fine by me. And if you drive across the United States, kind of makes you proud as an American, because the guys in the trucks are all wearing masks. The rest stops have never been cleaner. You can bring a glove and grab the pump and pump your gas. So it's actually been relatively safe for us.
Great. Mark, as a long-term investor, has disruption presented you with new investment opportunities?
Yeah, several. And again, we tend to hold stuff for a while, so we think a lot about the industry first. And I think there's a few trends that we're seeing, and I'll focus on one in particular, which is all the disruption going on in supply chains. And from a macro perspective, look, even go back before COVID, there was e-commerce growth. There's all this last mile consideration going on. But even more than that, there's a lot of demand around real-time tracking, not just for your Amazon package, but we used to own a relocation business, and knowing that your boxes moving from Houston to Shanghai, or Dubai or something like that, it's all multimodal, and keeping an eye on where every single package is kind of mandatory at this point in time. So there's a lot of change going on there. And even sort of sweeping through the supply chain, and this is again all pre-COVID, people want to know, they want non-GMO product as an example. Well, that traces all the way back to which rail car had the non-GMO wheat in it. And that's a lot of change that was shifting through the supply chain before COVID. Now you layer COVID on top, people staying at home. Again, the obvious stuff, people aren't going to restaurants, so food service volumes are down, but people are buying food at supermarkets. So things have shifted in that sense. But there's a lot more consideration around things like safety stock, right? Inventory used to be bad, and it's bad except for when your shelves are empty. So people are starting to rethink in supply chain, okay, what is the right amount of inventory to have at what point in the chain. So there's a lot of things going on like that. Warehouses are shifting protocols around because of the virus. And so you've got change going on because of COVID. And then finally, you've got US and China decoupling. And that is pulling supply chains closer to home. And so you take all those trends, wrap them together. And for us, it's an example of an area where there's a lot of opportunity. So that's the macro. The micro, and I'll just give you a couple examples of things that we've done recently. The first one is we bought a Jones Act shipping company, which doesn't sound that interesting, but if you want to ship product into Hawaii, this is a niche that we found. There's only 2 companies that do it, right? And not air freight, but if you want to ship a car, food, furniture, you name it, the TV set might come from China, but it actually doesn't go to Hawaii. It actually goes to Long Beach, and then it goes back to Hawaii. And there's only 2 companies that actually ship product into Hawaii. So that's a niche, all right? And that works in good times, and it works in bad times. And as I mentioned before, when you try to, where's logistics going to be 15 years down the road? We don't know exactly, obviously, but I know that if there's people in Hawaii, they're going to need food, and they're going to need furniture, and they're going to need cars. And having an ability to manage through a limited supply chain capability into that market is a very defensible, nice niche. So that's an example. Another one is agricultural manufacturers, and a lot of people have seen this before, but overnight parts delivery to their dealers. All right, so you've heard the analogy, the tractor breaks down, I got to get it fixed. A lot of money's being lost while the tractor's sitting there, so I got to get a part flown in or whatever. So we have a company that ships product from the OEM to every dealer across the country, literally overnight. You can put an order in at 5 p.m., it's to the dealer by 6 a.m. It's nice in this environment for a couple of reasons. One, most deliveries are very undependable. So if you can guarantee delivery, that's a big deal. 2, people may not be buying new equipment, but if they're not, they're using the old equipment. And just like TJ said, there's a lot of used cars on the road. Exactly. And those used cars are using more parts, right? So it's a little counter-cyclical, and that's a real plus for us. The bigger thing over time, though, is it's not the need for that one piece of equipment or part. It's dealers have figured out, wait a second, if I can order my parts at 4 p.m. or 5 p.m. and they'll be there for the next morning, why do I carry any inventory, right? I don't need that little one-off piece. I'll just strip the inventory out of my dealership. And if you've ever looked at dealer economics, that's a huge part of their working capital is the parts inventory. So again, totally different business, very niche-y. And I'll give you just one third example. We just purchased a air freight company that ships perishable product from the West Coast to Asia, Africa, and the Mideast. And there's, this is strawberries and blueberries and things like that. There's a huge demand for California product, number 1. 2, it's complicated as heck because it's perishable and the distance is long. So there aren't very many people who do it. There's a lot of complexity to it. And again, it's not a huge business. It's probably a couple $100 million in revenue, but it's a very defensible niche. So I'll kind of pause there, but we try to take these macro trends that we think are going to be around for a while, sit underneath them and see if you can find a little niche that's got some barriers around it.
Great. Are you seeing any other types of opportunities that are not industry specific?
Yeah, and I think TJ started to touch on this before. One thing that, again, pre-pandemic, we were watching was the amount of industry concentration that was going on, and not just tech, but across a lot of industries. The big kept getting bigger. And there's 2 parts to this. I think one, just in the public arena, if you're a public company, a small micro cap, there are so many less analysts who are covering the public market right now. You can't get the time of day. You can't get access to investors. Another trend is all the index funds. So there's nobody on the other side of the phone to talk to. There's an index and they're buying your company at the end of the day. And so I think, and I think this is interesting for PE, there's a fair amount of micro cap companies out there that may have some really good economics, maybe performing really well, but are in a sector or a category that's out of favor. And people make these allocations. I'm going to get out of energy. I'm going to get out of agriculture, whatever. And, you know, probably fair for 90% of the companies, but there's probably a few gems hidden in there from a public perspective where a company could, you know, you could turn around and take it private. So I think that's one aspect. You know, another one in terms of concentration is just what COVID has accelerated, right? Which if you're a smaller company, everybody's trying to survive right now, but staying power and the ability to outlast COVID, right? That's first and foremost on a lot of people's minds. But what everybody's not thinking enough about is, hey, there's other problems out there and there's other disruptions. So everyone's trying to just work through what does COVID mean. We had a short line railroad, another logistics business, that dealing with COVID had about 20% of its business coming out of the oil industry, which has been suffering. So that was a hit to the business, and then just got hit by a hurricane. And so I think something smaller businesses are starting to realize is it's one thing to deal with COVID. Okay, it's another thing to say, well, I used to have cushion. That cushion just got dried up. It's gone. And the next time around, I'm going to be in some real trouble. I think small businesses too are thinking about post-COVID, a lot of people are going to have to change or revamp their business model. Okay, so whether it's restaurants or retail or warehouses, the way it works today, probably in the wrong place, and they probably are laid out wrong. I just started coming back into our office, walking around the building. I mean, it's empty, that's one thing, but the layout doesn't work. I mean, it really isn't going to work going forward. So I think there's a lot of businesses that may survive, may be fine, but they're going to look at their core business and go, wait, this isn't laid out correctly. My footprint isn't correct anymore. I think retail is a glaring example of that. And so people on this call, I think there's a lot of opportunity for smaller businesses to help them grow, help them sort of tweak their business model to adapt to what the future is going to hold for them post-COVID. And then, like, I think TJ touched on this, but just being under an umbrella, right, where it's frankly a little safer at the end of the day. I know there's a lot of families who have family businesses who have been calling us recently saying, all our equity's in this one company, and COVID's been so scary, like, I can't see all the equity disappearing. So this idea of, and Rich mentioned this too, you know, we take a lot of stakes in companies where we're 55%, 60, 70%, and we want the ownership with the family to, you know, have a decent stake in it. There's a lot more of that going on right now because I think families are saying, wow, I used to like to run this. I still want to be involved, but I got to take some chips off the table. So I think there's a lot of opportunity there.
That's it, Mark.
Any comments?
I'm going to stay after that. I'm staying home. or I'm going to get in on Mark's. I'm going to get in on Mark's Hawaii deal. That's what I want to get in on. So, Mark.
Well, you know, Rich, and again, you know, some of these companies we all find, you know, they're also interesting in and of themselves. But you say, okay, well, yeah, look, we would love to find another deal like that because it's really neat. There's always a catch, all right? And the catch was this company got in trouble because they were trying to build a new ship. And they lost their financing, and they were going to lose the berth to build the next ship. It was going to be given away, and they had 34 days to close. And so the day we heard about it, we had 34 days until we wired the money. All right, so that's like another thing we can do because guess what? It's Sam's money. He's across the hall. We have some flexibility there. It's you know, nothing's free out there, right? There's always a catch to it. And I won't bore you guys with how we did it, but a lot of structuring obviously went into that. It wasn't just we dropped equity into the company because you can't diligence a company properly in 34 days. So there's always a twist to making these things work and to getting outsized returns. But yeah, it's a great business and we love it.
Giving that in terms of what's going on in the market, you know, there does seem to be so much capital out there, but prices don't seem to have fallen that much in terms of you know, what these companies are looking for. So how do you invest and how do you create the outsized returns that you're going to expect? Any comments on that?
I'll be happy to take this one if you like. We've actually had very good pricing. It's driven by, and I think Mark made this point before, there's a lot of things going on besides COVID. I mean, part and parcel of that, if you're an owner of a business, it certainly puts front and center your mortality and the fact that, you know, maybe you can't manage through it, or you get something else like a hurricane. And you have a presidential election coming up. There's a lot of owners of businesses who say, hey, can you close this before year end? Because I don't want to risk paying higher capital gains next year. There's a big concern about that. So actually, we closed on one business that was, we paid a little bit more than 5 times EBITDA, which was in less than 6 times free cash flow, market leader. And now part of it was we cut the price before the performance really took off. So it's gotten a little bit of a COVID lift, if you will. And then in another business, we have in it 7 times. So what we found, although it's changing right now, but we found the last 3 months was a great time to be in the market buying. I'm told that that's going to begin to change a little bit. But part of it was, you know, we were very fortunate, thank God. We didn't have a lot of problems in our portfolio, so we had the bandwidth and the availability to go out and look and buy things. And then secondly, we were willing to do what it took. I mean, if we had to get a hold of a couple of lenders and split the cost of chartering a plane or hop in an automobile, we did it. And I did stay at one hotel in Kansas, and when I checked in, there was a sign at the reception desk that said bird plucking room in the back. I wasn't quite sure what that meant, but we were willing to do that to look at the business. So.
But see, Andrew, that's the heart of it. TJ talks about it, and I think the fact he would get in a car and drive 1,000 miles, like he mentioned before, I think the nature of relationships in this environment and specific to the type of businesses in the middle market that we all focus on really plays a huge, huge factor. Because as I tried to sort of differentiate us from others, and I think that both Mark and TJ have seen this movie many, many times, there is a huge group of private equity firms that seek 100% or 95% control and full ownership. They want to cut costs, use high leverage, you know, to achieve their target returns, and they have their own playbook. It's very different when you come in and you invest in partnership with many of the companies that TJ and Mark have highlighted, because know where the bodies are buried. They have a plan. They're looking for additional resources. They appreciate operators that have become investors. And on the far end of the other side of the spectrum, they're probably getting cold called by, you know, 10, if not 100 growth equity firms that are targeting businesses where they can make a minority investment and have a preferred security on top of it. And it's not true partnership. And I just think that in this environment, no matter how expensive things may become, when you have great relationships with sellers who become as much a buyer as a seller, and to TJ's point, when you have great relationship with lenders who are going to give you a wide berth to structure something that could be creative, I think ultimately you weather the storm here.
Yeah, and I'll add one more thing to that. I think that's dead on. You know, I used to be an operating partner too, and what I think is so interesting about the private equity industry is we all buy these companies and analyze the markets and the competition and all that, and people don't think enough about ourselves as an industry. And I think there's a lot of commoditization of what a lot of people in private equity do. And when there's 25 people bidding on the same asset and we've all got the same cost of capital and the same people running the same models, I don't know what you call it, but it sounds kind of commodity-like to me. The idea of getting in a car and driving 1,000 miles, that's elbow grease, right? That's actually value add at the end of the day. And I think what you're going to see over time, and this isn't a COVID issue, I think this is just where the industry's headed. I think it's obviously, there's so much capital out there, it's getting harder and harder and harder just to go find a bargain, right? I think we would all, if we could find a great company really cheap, we'd all do it in a heartbeat. I think, and for people on this call, what's great or important is going to be to find really outsized returns. You have to, we use the word complexity a lot. You have to go places and do things that a lot of other people won't go and do, okay? And that could be financial complexity, that could be operational complexity, but you have to find situations where there aren't 25 people just like you bidding on something, because by definition, you know, it's gonna be much more competitive. And so where is that at this point in time? Well, it's within the company, right? If we can buy something cheap, that's great, but the value creation in the company is going to be more and more and more important over time. And I think we all kind of believe that anyways, but I think you're going to see even more of it because there's plenty of people. You can pick almost any topic you want, and there's 5 or 6 funds that focus on it. We do some energy, and I know a fund that all they do is invest in frac drilling in the Permian Basin. And that's the fund. It's not the company, that's the fund. That's literally all they do. Well, guess what? They're probably really darn good at that and pretty focused on it, right? And so, you know, if you're going to create outsized returns, you've got to be a little better at people at doing certain things. And that to me means finding things that are really hard to do. And so we like to say all the time, if you only need capital and that's all you want, we are absolutely not the people to be talking to. Okay, and so if you want to buy 100% of something and you're going to sell it to the highest bidder and you're going to race a process and we really can't get to know management and really can't understand what the company is and what they're doing, okay, fair enough. That's your prerogative. It's not for us at the end of the day. It's easy to say it. It's really hard to do, obviously. But I do think you'll see more and more and more of that going on.
Great. No, great points. Great points. In terms of doing these deals and the uncertainty, and I think TJ's points about the year-end capital gains and people wanting sort of do everything, has it changed the way you structured deals? I was hearing early on the day that people are escrowing a COVID premium, to make sure the business comes back, and you talked about sort of working with the debt lenders. So, are you seeing that you're approaching things in a different way with the current environment?
Who would you like to take this, Andrew?
TJ,
so the answer is yes. There is some thinking that has to go into pricing vis-a-vis getting a COVID bump, or the other way around is if the company's hurt by a one-time event. Maybe you realize that you can pay a certain price because it's a non-recurring event. That's something you have to think about. The other thing is in the PPP loan business is that a number of these companies we've looked at have gotten some government support, and then you have a question, well, do they have to pay that loan back, or is it going to be forgiven? It's still unclear. Some banks won't even process applications for the forgiveness of these PPP loans, so do you have to escrow that? So there's a lot of these questions, and I think you have to look at all the issues very carefully.
Rich, any comments?
Yes, Andrew, I think in a couple of cases that we've seen, when you're dealing, a lot of times your sellers are actually not just founders or management teams, they're actually sponsors, right? They might have gotten to the end of a fund, they're looking for an outcome, they think it's too early to sell the business. There's a lot of innovative ways that we've had discussions and dialogues about how you would structure something. So in the founder and management team cases, we've had folks that have been so successful at running their own businesses, the last place they want to go when watching a stock market that's completely dislocated from reality is to have some big outcome and go put it in the market. So whether it be some seller financing at a significant level, almost eliminating, whether it be a DDTL for add-ons or, just some large loan package with some type of second lien component. We're seeing very creative financings from folks that actually can afford to do it. They've run that business for a while. And then there's just been a number of different, rather interesting ways that sponsors have found ways to team up, and you read about them all the time, different by organization. But we found that to be also an interesting way that people are navigating the last 6 months.
Right. Mark, any comments?
Yeah, and I wouldn't add much. I mean, I think what they both said is right. I mean, it's just, look, there's a lot more playing a little higher in the capital structure. This converts, there's more preferred opportunities out there. There's not just seller notes, but there's some more earnouts that we're seeing, things like that, where, the buyer's sitting on this side of the table going, I don't know how to underwrite the next 2 years. It could swing, is it going to be a bump up in COVID again or not? And the numbers swing wildly, right? So, you're trying to push a little bit more of that risk onto the seller to the extent you can. And there's a lot of techniques to do that. Again, it's just what the market is willing to bear. If somebody needs to really sell, and I think this issue of year end with taxes is really bubbling up with people. We've got a couple things with people racing to close right now, worried about next year. And so you're able to demand a little bit more to make sure that the transaction gets done. But I think, look, it all just revolves around this. There's so much uncertainty in trying to predict the next 2 years that I keep thinking about the underwriting. And another thing people don't talk about enough, it's when you try to underwrite right now, it's not just, hey, what do you think about the next couple of years? But what do people think exit multiples are going to look like, right? And it's, I don't know, it's tough, right? But how much of the value is tucked in the exit multiple? And what do you think that environment's going to look like in a few years? So it's really difficult right now with certainty or any reasonable amount of certainty to feel good about some of those predictions. And so, taking a little less risk, and again, maybe converts, things like that. And we're just seeing a lot more of it.
We talked about V-shaped recoveries. We talked about W-shaped recoveries. A lot of people saying we won't be back to normal until end of 2021, 2022. Do you see another distress cycle coming? And do you see that we'll be approaching another, going into the portfolio companies and trying to emphasize being defensive mode and being prepared? Rich?
Oh, wow, Andrew, I was just going to say, I was just going to follow the order and follow TJ. TJ, go first. You're going to mess me up. Go ahead, TJ.
It's all yours, Rich. Have fun.
Oh, well, in that case, boy, that's a tricky one, particularly out here in the state of California where everyone has their own opinions about how things are going. We spend so much of our time sitting in Silicon Valley in a lot of tech and tech-enabled service businesses that have been less impacted. So when we think about that recovery, so many of our businesses have cash flow characteristics that are less attuned to some of the challenges that what I would call, Main Street businesses are going through, like other parts of our portfolio. Thousands of people affected on the auto side or end markets, as we talked about before, geographically, that would also be impacted as well. So it's really hard because you just can't, I think Mark said this, you just got to go and you got to figure out a way to navigate this. I don't think anyone has the right answer, but we're looking for resilient businesses. And I keep coming back to it because it's the easy thing to do. We're really looking for really strong people where we can bring an operating bench of folks, much like many on this call today, that can support those companies through whatever this recovery may look like. Boy, if I had $1 for every accurate, having lived through a number of these cycles that the guys have seen the movie in the past for, I don't think I was right in any one of them. It's like when you try to underwrite a deal, right, and price a deal at a 25% IRR with 80% confidence, never happened. And I don't think it's too dissimilar to this situation.
All right.
Yeah. The other thing I'd add is, look, I think it absolutely depends on what sector and industry you're talking about. Energy is in distress right now, so have at it. It is distressed. Retail's distressed, right? All that logistics stuff I was talking about, they're booming, and probably will for a while. And you got everything in between. We own a hospital chain. All right, so yep, we went through all that stuff with the respirators and PPE and all that, and the safety issues, and but we're getting government money. And like TJ said, it's confusing as heck. Like some of that money came in as grants, and now they're saying we got to pay it back. But at first we didn't have to pay it back, and trying to weave through all that stuff, is crazy. So I think there's a spectrum. I think you can find distress right now if you're willing to step into certain parts of the economy. I think there's probably more coming. Unemployment's not good, right? If you just threw the word COVID out for a second, there's some metrics out there that really don't look good at all. The flip side is there's a lot of capital, there's a lot of government support, and there's low interest rates. So, you got to toggle all those things. And I think the answer is there's no generic yes, no. There's just, you got to stare at each individual sector. Tech's, lots of tech is booming. Anything surrounding the home is booming. This that short line railroad I talked about, they ship lumber. Okay, it's unbelievable, right? The inflation on lumber right now because people are trying to build homes in the suburbs. Okay, well that piece, that is just booming along. But boy, if you want to do anything with oil right now, forget it. So I think you got to really parse what part of the economy or the sectors you're looking at.
All right, TJ?
No, I agree with both Mark and Rich. I think, first of all, with regard to what Rich said, is, you know, if you had a nickel for every prediction that was out there, I mean, you'd be a rich man. It's amazing to me to listen to these people on television, and sometimes I've been fortunate enough to have lunch or breakfast with them, and they make these predictions of what the economy is going to look like in a year. And I remember what they said. I can't remember if anybody's ever been right. It seems like every single time they're wrong. I remember 3 years ago, a futurist from Stanford drove hands-free from Silicon Valley down to LA, and he predicted in 6 months 100% of the country would be in autonomous vehicles. I'm like, well, I don't know. I'm still driving my Suburban around, so I guess. And then, you know, I think to the point that Mark made, which is a very good point, and frankly, I've made this mistake in the past over time, is coming out of the 2008 Great Recession. I was very slow to deploy. I kind of underestimated QE continuing. And what you realize is there's a lot of microclimates out there. It's really industry specific. And you can go through a really rough time nationally, or even in a geographic area like the Permian, like Mark mentioned. But you can still do well if you sort of pick your spots and you're in the right industries. So there are microclimates, and be wary of the people that predict the future. So.
Good advice.
Okay, I think we've come to the end of the session. Any closing thoughts to our participants?
Appreciate you having us, Andrew.
Yeah. Great.
Thank you.
All right.
Thank you very much. Appreciate
Thank you,
it.
Jonathan. Thank you.